Okay, and let's look at another strategy we use in down markets. We call it the profit guard strategy. And one of our portfolio management rules calls for us to protect profits whenever we have a profitable stock or option directional trade. So if we purchase a stock and we have a profit, then we want to create a spread to protect that profit by purchasing a put. And if we purchase a call option and we have a profit in the call option, we want to protect those profits by purchasing a put option. So whenever we have a profitable direction trade, we create a spread trade to help protect our profits. And when you purchase that put option, that gives you protection that enables you to profit in down markets even if your stock or option declines substantially. And we'll show you some examples of that. And as you'll see shortly, buying that put option for protection can, in many cases, can even guarantee that you'll have a profit for your trade regardless of the price movement of the underlying stock or ETF. So if we have a profitable directional trade, we always want to establish a spread trade, a profit guard trade to protect those profits. We'll look first at the profit guard option strategy. We also trade this for stocks too, but we'll look at the option strategy first. So Prime Trade Select has produced a lot of profitable call option trades over the years, and when you have a profitable call option trade, that always poses a dilemma. Do you hold on to that winning call option trade for further upside profit potential, or do you take profits in case the stock declines in price with the possibility of a profitable trade turning into a losing trade? And we know from experience that it's very difficult to watch a winning trade develop into a losing trade. This is hard on your psyche as a trader, and it can help you lose confidence in your ability to be a successful trader. So nothing's worse than seeing a profitable trade turn into a losing trade. So the profit guard spread strategy solves this winning trade dilemma. And what we do is we hold on to our profitable call option, and that will continue to profit if the underlying stock increases in price, and at the same time you're protecting those profits in a down market. So if we go into a down market by purchasing that put option, that protects your profits in your call option trade. And put options profit as the price of the underlying stock declines, and if you have a winning call option trade, purchasing a put option provides a profit guard that can help protect you against losses for your call option investment in the event the underlying stock declines in price. So when you have a profitable trade, you always want to protect those profits by purchasing a put option. And at the same time, purchasing that put option does not limit the upside profit potential on your call option if the underlying stock continues to increase in price. So once you establish this profit guard spread, bad earnings reports don't matter anymore. A severe sell-off in the markets actually produces windfall profits with this strategy, and there's no need to worry about placing protective stops. You don't have to worry if there's a big decline in the stock market when you have that put protection in place. So you can literally place that trade, and once you buy the put, you can ignore the trade until option expiration. And as we'll see in a minute here, purchasing the put option insurance can even guarantee that you'll be successful with your trade. So this transforms option investing from one of the riskiest investments to one of the lowest risk investments by purchasing that put option. Now, because there's a long position, which is the call option that you purchased, and a short position, which is the put option, this strategy is also known as a market neutral spread. And market neutral spreads can profit if the price of the underlying stock goes up, down, or remains flat. And a sharp decline in the price of the underlying stock can result in a windfall profit. And your risk is limited to the cost of the spread. You can start out with a $5,000 trading account, and we normally go out 1 to 3 months on a trade. So let's look at a trade example. This is for the healthcare ETF, symbol XLV. The healthcare ETF was on a prime trade select buy signal. So our online brokerage report shows that we purchased 64 of the 50 strike calls at 960. So it was on a prime trade select buy signal, purchased the 50 call at 960, and the trade was profitable. So we created a spread to protect the profits, and our transaction history shows that we bought 64 of the 75 puts at $4. So had a profit in the call option, wanted to protect those profits, so we bought to open the 75 put at 4 points. And that created a market neutral spread. And the 50 strike call option, of course, profits as XLV moves up in price, and the 75 strike put that we purchased profits if the XLV moves down in price. So again, we bought 50 strike call at 960, bought the 75 strike put at 4 points. And we also have a calculator that will calculate the profit potential for market neutral spreads. And let's take a look at this XLV trade. XLV was trading at 71.44. We bought the 50 strike call at 960, and bought the 75 strike put at 4 points. And it will calculate the profit potential assuming various price changes in XLV at option expiration. In this example, from a 30% increase to a 100% decrease in price. Now, we don't expect the XLV to decline that substantially, but we just plug that in there just so you can see how the strategy works. So we can see from the calculator that if XLV price is flat at 71.44, then we'll realize an $1,100 profit on the spread and an 83% return. A 20% increase in XLV will result in a $2,200 profit and a 162% return. And you can see as the price of XLV goes up, your profit potential also increases. So there's no limit on the profit potential with this spread trade if XLV continues to move up in price. And whenever you can profit, if your ETF is flat at option expiration and you can realize an $1,100 profit, an 83% return, that's going to result in a higher percentage of winning trades compared to just taking a directional trade. So we always want to protect our profits with directional trades. And we can see that if the XLV decreases 40%, we wouldn't expect that kind of a move, but this is just as a way of showing you how the the strategy works. If it decreases 40%, then we realize an $1,800 profit and a 136% return. And you can see the more it goes down, the more profits it generates. So in this case, the put option is providing total downside protection in down markets. Once we purchase the put, we don't have to worry about protective stops or big down moves in the market, and we just hold this trade until option expiration. So the profit guard spreads can profit if the price of the underlying stock goes up, down, or stays flat. A sharp decline in the price of the underlying stock can result in a windfall profit, and your risk is limited to the cost of the spread. And again, bad earnings reports don't matter. A severe sell-off in the markets doesn't matter, and you don't have to worry about placing protective stops with this strategy. And the profit guard spreads can provide total downside protection during down markets, and there's no limit on upside profit potential. And in many cases, the spread can guarantee a profit. So let's just take a quick look. This is a snapshot of a brokerage portfolio, brokerage account portfolio that shows we had a $901,000 in open trade profits, and this is for the profit guard option spreads and also the profit guard stock spreads. And the report lists the cost of each stock and option, the current price, profit, and percent return. And all but one of the stocks in this portfolio declined substantially after we established the spreads. So all but one of the put options were profitable. So for most of the spreads in this portfolio, the put option was profitable because there was a substantial decline in price. So all of the put options, of course, were in place to protect the profits, and purchasing the put option in most cases for this portfolio guaranteed a profit for the trade. So here's a snapshot, lists the stock in this column. It lists the price paid here, the current price, and then our total dollar gain in this column and total percent return in this column. So you can see that all the put options were profitable except for one, as there was a substantial decline in the market after we established these spread trades. So this protected us in down markets, and we had a $901,000 open trade profit. So we have an option trading service, and email alerts are sent out to members with specific instructions whenever there's a new option trade recommendation, or if we're going to close out an existing trade. We have a portfolio of option trade recommendations, and the prices are updated daily in real time, so members can track the profit performance for every one of the trade recommendations. And we also maintain a closed trade record of all closed trades, so that we have a full accounting of all trade recommendations on the website for our option trading service. And we also make the 6 option calculators available to members of the trading service. So if you want to check option trades before you take them, you'll have the calculators to use as a member. So again, if you want to log on and see how our various strategies are working, you just log on to weeklyoptionalert.com and click the trade results page, and that will list updated profit performance for these various strategies that we trade. Or you can call Brad toll free at 866-661-5664 or 310-647-5664.